Cold open. The U.S. Treasury just doubled the buyback. Bitcoin did not double the cap. That is the receipt. This week, the government moved to buy back more long-term Treasury debt. The reported cap went from $2 billion to at least $4 billion per operation, focused on bonds with 10 years or more to maturity. The goal was not mysterious: calm a stressed bond market, improve liquidity, and push back against rising long-term borrowing costs. And at the same time, Bitcoin ripped higher. That does not mean the Treasury caused Bitcoin. It does not mean a price rally proves Bitcoin right. But it does give us a clean comparison. One system has officials stepping in to buy the receipt. The other has a supply rule no official can rescue, suspend, or expand. This is the weekly rebuttal. Steelman first. Treasury buybacks are not automatically crazy. A government bond market is plumbing for the entire financial system. Mortgage rates, corporate borrowing, bank balance sheets, pension funds, insurance companies, collateral markets, and global reserve portfolios all touch Treasury yields. If long-term yields spike too fast, the pain spreads. Borrowing gets more expensive. Stocks can reprice. Housing gets squeezed. Debt service gets louder. And because Treasuries sit under so much of the financial system, bad liquidity can turn a pricing problem into a stability problem. So the official case is simple. The Treasury is not trying to erase the national debt with a buyback operation. It is trying to improve market functioning. If one part of the curve is stressed, buy back some older, long-dated securities, issue elsewhere, smooth the plumbing, and reduce disorder. That is the Steelman. Markets need functioning rails. A buyback can be a liquidity tool. The government already manages issuance, maturity profiles, cash balances, auctions, and refinancing. So buybacks are another lever inside a managed debt system. Now the rebuttal. That is exactly the point. Fiat debt markets have levers because fiat debt markets are managed. When the receipt gets uncomfortable, officials can change the plumbing. They can buy back old debt. They can issue more short-term bills. They can adjust auction sizes. They can extend, shorten, refinance, intervene, signal, coordinate, and explain. Some of that is useful. Some of it may be necessary, but none of it makes the receipt disappear. A buyback can move duration around. It can improve liquidity. It can temporarily calm yields. It can make the market less disorderly, but it does not answer the deeper question: why does the largest bond market on earth need the issuer to step in because long-term debt is getting harder for the market to digest? That is the receipt. The problem is not that the Treasury has a toolkit. The problem is that the toolkit exists because the system keeps producing promises that have to be rolled, refinanced, managed, and defended. A bond is a promise. A deficit is a new promise. Interest is the receipt for old promises. And a buyback is what happens when the promise market needs official help staying orderly. Bitcoin's claim is narrower and colder. Bitcoin does not promise a smooth chart. It does not promise low volatility. It does not promise protection from bad entries, leverage, custody mistakes, panic, scams, or bear markets. Bitcoin is not a rescue program for your portfolio. But Bitcoin does make one claim that fiat debt cannot make. There is no Treasury desk for the supply cap. No secretary can announce a buyback of the 21 million rule. No agency can issue more Bitcoin to calm the market. No auction calendar can refinance the cap. No committee can move issuance from long-term scarcity into short-term convenience. No official can say, "We are doubling the supply operation from 2 million to 4 million per meeting." The rule is either valid or it is not. Nodes verify it. Miners propose blocks. Nodes reject blocks that break the rules. That is the difference. In fiat, credibility is managed by officials. In Bitcoin, credibility is checked by users. That does not make Bitcoin anti-America. It does not make Treasury officials villains. It does not mean every intervention is evil. It means you should understand the type of system you are looking at. The bond market asks, will officials keep the promise market functioning? Bitcoin asks, do the rules still validate? Those are not the same question. This is why the price move is not the main story. Yes, Bitcoin rallied while the Treasury buyback story hit the tape and crypto policy optimism picked up. Yes, short liquidations and ETF flows can add fuel. Yes, the headline number grabs attention, but price is not the proof. The proof is structural. The Treasury can buy back its own debt because the dollar system is built around managed promises. Bitcoin cannot buy back its cap because the cap is not an official promise. It is a consensus rule. And that is the cleanest way to read this week. Do not worship the candle. Read the receipt. One system needs a buyer of last resort for its promises. The other needs users willing to reject invalid blocks. Treasury can buy the receipt. Bitcoin does not need a buyer for 21 million. Educational only. Not financial, legal, tax, security, privacy, or investment advice. This is exit velocity. Think in Bitcoin.